students, come on, we'll resume our previous discussion on investment management portfolio theory. So previous session we have stopped at the limitations of Markowitz model. What is Markowitz model we have seen. Now what are the limitations, assumptions of Markowitz? The first assumption was investors are rational and behave in a manner as to maximize the utility with the given level of income. तो नॉर्मली ये assumption के ऊपर मार्कोविट्स अपना थ्योरी बनाया है. ये assumption है कि investors behave rationally, means before taking any investment decision, the investor will evaluate what would be the consequences, how much return we can get, how much risk we are taking. Every calculation he will make, and his objective is to maximize the utility with the given level of income. That is the first assumption of Markowitz. Then second assumption was investors have free access to fair and correct information. All the investors are having access to the full information about the market. Nobody has an edge over information. Everybody will have equal information. Thirdly, the markets are efficient. One of the assumptions of Markowitz was the market was efficient. The market will absorb the information and immediately it will be reflected in the prices of shares. That means the markets are very, very efficient. Fourth one, investors are risk averse. Risk averse means the investors don't want to take the risk. They are risk averse. They avoid the risk. Then fifth one is investor-based decisions on expected return and variance or standard deviation. Then when every investor will make his decision on the basis of two factors, that is return and risk. The risk is measured in terms of variance. Investors choose higher returns to lower returns for a given level of risk. A given level of risk ke liye they will prefer the higher return than the lower return. These are the assumptions on which the Markowitz have given a theory. So in examination you may be asked what is Markowitz theory, portfolio theory, and what are the assumptions. So these are the assumptions. The next topic is regarding the limitation of Markowitz approach. See, Markowitz has given a good portfolio theory on how to calculate the expected return and risk of a portfolio. But this theory also suffers from some limitations. The limitations are the assumptions on which the theory is based. तो सब में बड़ा लिमिटेशन ये मार्कोविट्स थ्योरी का यही है कि ये थ्योरी बेस्ड ऑन assumptions है और assumptions are far from reality. First assumption, the investors behave rationally. It's very difficult. Most of the investors will not take rational decisions. They may take irrational decisions. Secondly, the information is not freely available to every person. Thirdly, the markets are not so efficient. There will be inefficiency in the market. So all the assumptions which are given by Markowitz are theoretical assumptions. Practically it will be difficult to apply. So these are the limitations. Another limitation of Markowitz theory was it requires a lot of calculations. If the securities are very few, only 2-3 securities are there, it is better to apply Markowitz theory. 2-3 security अगर है portfolio में तो हम easily Markowitz theory apply करके calculate the expected return and risk to evaluate the portfolio. But when the security increases, अगर 4-5 security अगर ज़्यादा रहेंगे securities तो definitely it will be highly difficult to calculate the variance, covariance among different securities. It will be very much difficult. So these are the limitations of Markowitz model. Now we'll come to the next topic called single index model or Sharpe's single index model. Now this is the next topic we are going to study in this unit. Sharpe's single index model. Actually, Markowitz model had serious limitations due to various rigors involved in compiling the expected return, variance, covariance, etc. तो मार्कोविट्स का सब में बड़ा लिमिटेशन यही है कि मार्कोविट्स थ्योरी में बहुत ज़्यादा कैलकुलेशंस है. अगर एक पोर्टफोलियो में नियरली 5 अगर सिक्योरिटीज है तो 5 expected returns we have to calculate, 5 variances we have to calculate, and we have to find out the covariances between different securities we have to calculate. So calculations will be very much cumbersome if more securities are involved. So Sharpe's model has been simplified this process by relating the return to a single index. अब ये लिंटर Sharpe has simplified the process ये पोर्टफोलियो को इवैल्यूएट करने के लिए मार्कोविट्ज जितना कॉम्प्लिकेटेड है उसको सिंप्लीफाई कर लिया शार्प by relating the portfolio with the market index, single index. So this market index is superior to Markowitz model because this will theoretically reflect all well traded securities in the market. अगर index calculate करें तो index will represent all the well traded securities in the market. मार्केट में जितने सिक्योरिटीज है उसका रिफ्लेक्ट करता, उसके परफॉर्मेंस को रिफ्लेक्ट करता सिंगल इंडेक्स. तो वी कंपेयर the portfolio performance with the single index of the market. Secondly, it will simplify the work involved. सब पे और एक second advantage superiority ये है single index model का, it will avoid the cumbersome calculations of calculating the expected return, variance, covariance of so many securities. तो ये superiority है of single index model. It is thus the market index used as a surrogate for other individual securities in the portfolio. Portfolio में पूरे securities को represent करने वाला market index. So William Sharpe tried to simplify the Markowitz model of diversification of portfolios. This is all about this Sharpe single index model. Next comes the risk-free rate. Risk-free asset is that asset in which there are no uncertainty about the return. For example, when you invest some money in the bank in a fixed deposit, the banker will promise that this fixed deposit will carry an interest of 12%. So we are sure, the investor is sure that at the end of the year he is definitely going to get the principal amount and interest with certainty. So the rate which is given on this asset is called risk-free rate. So normally this risk-free asset will be issued only by the treasury bills, government. So government can issue the securities which are risk-free, but no company, no corporate can issue risk-free securities. Always risk is attached with the corporate instruments. Next comes CAPM model, capital asset pricing model. This is very, very important from examination point of view, also practical utility in calculating the required rate of return and valuation of security. So what is the CAPM? CAPM was developed by Sharpe and Linter in 1960. First of all, this capital asset pricing model CAPM was developed by Sharpe and Linter in 1960, and the model explained the relationship between the expected return, unavoidable risk and valuation of security. तो ये CAPM मॉडल जो है रिलेशनशिप शो कर रहा तीन चीजों के बीच में, expected return, unavoidable risk and valuation of security. What is this unavoidable risk? The term unavoidable risk means risk which cannot be diversified. In simple words, we can say market risk. जो कंपनी रिस्क रहता वो अवॉइडेबल है, डाइवर्सिफाइएबल है. जो मार्केट रिलेटेड रिस्क है वो नॉन डाइवर्सिफाइएबल है. इट कैनॉट बी अवॉइडेड, अनअवॉइडेबल रिस्क. So this CAPM shows the relationship between these three: required rate of return, expected rate of return, unavoidable risk and the valuation of security. The greater the unavoidable risk, the greater is the return expected by the investor from that security. जितना रिस्क ज्यादा रहेगा उतना ज्यादा एक्सपेक्टेशन ऑफ द इन्वेस्टर रहेगा. एग्जाम्पल, अगर सिस्टमैटिक रिस्क इज मोर, देन द इन्वेस्टर विल रिक्वायर ए हायर रिटर्न फ्रॉम दैट सिक्योरिटी. अगर उसका एक्सपेक्टेड सिक्योरिटी वैल्यू कम है तो इट इज ओवर प्राइस्ड इन द मार्केट में ओवर प्राइस्ड है. तो वी कैन फाइंड आउट वेदर द सिक्योरिटी इज ओवर प्राइस्ड और अंडर प्राइस्ड by calculating the return as per CAPM. And CAPM return is based on non-diversifiable risk, unavoidable risk. Hence, in case of security does not provide adequate commensurate with its unavoidable risk, so we calculate CAPM rate of return and we compare this CAPM rate of return with the required rate or expected rate of return of the security. The security will not favor the investor. अगर CAPM रिटर्न कम है और एक्सपेक्टेड रिटर्न ज्यादा है तो मार्केट में वो सिक्योरिटी अंडर प्राइस्ड. द CAPM वाज डेवलप्ड टू एक्सप्लेन हाउ रिस्की सिक्योरिटीज आर प्राइस्ड इन द मार्केट. तो मार्केट में कितनी रिस्की सिक्योरिटी है ये मालूम करने के लिए वी अप्लाई CAPM मॉडल. तो Markowitz theory more theoretical, CAPM aims at more practical approach to stock valuation. Stock valuation में this CAPM model is very much helpful in finding out whether the security is overpriced or underpriced. That is CAPM. But CAPM is dependent on some ideas, some assumptions. The first assumption of CAPM was the required rate of return on all financial assets depend in part on riskless rate. The return of every security depends on the risk-free rate or riskless rate. So we can find out the required rate of a return of security by making a relationship with the riskless rate. That means every return is related, is connected with the riskless rate. Second, investors are primarily concerned with unavoidable risk. They are concerned with unavoidable risk. That means the investors are not bothered about avoidable risk because they can be able to control it by diversification. But unavoidable risk cannot be avoided. So they are more concerned, investors are more concerned about unavoidable risk. Investors require premium for bearing the risk depending on the degree of risk. तो इन्वेस्टर्स ये चाहते हैं जितना रिस्क ज्यादा है उतना रिटर्न भी हमको ज्यादा चाहिए. Higher the return we want if we want to take higher risk. Since the investors are risk averse, the higher the risk, the greater is the expected return. That's why in CAPM we can find out the return by using a formula. So according to CAPM return of I security is equal to risk-free rate plus beta of I security into market return minus risk-free rate. So the required rate of return RI is equal to the risk-free rate plus beta times of risk premium over the market. Beta times of risk premium over the market. This is the risk premium. This is the beta time. So we can find out the required expected rate of return as per CAPM by using this equation. Next, assumptions of CAPM. The first assumption, capital markets are highly efficient. That means investors are well informed. So all these are theoretical assumptions कि capital market well perfect है, efficient है और transaction costs are nil. There are no brokerage or commission payable and no investor is large enough to affect the market price. एक single individual investor अपने action से market price को change नहीं कर सकता because there are many investors in the market. A single investor cannot affect the market price. Investors are risk averse. Investors are assumed that they don't want to take the risk. Investors have homogeneous expectations regarding risk and return on securities. हर एक investor का assumption एक ही रहता. They want to increase the return and reduce the risk. So above analysis shows that management of investment portfolio is a difficult and complex task. अब इतना discussion के बाद ये conclusion पर है कि management of portfolio is not a simple task. It's a very complex task to manage the portfolio. It requires not only critical evaluation and appraisal of general economic condition, relative position of industries, financial and other strengths of the particular firm, but also on understanding the pattern of behavior of share prices in the stock exchange. तो ये portfolio manage करने के लिए बहुत सारा information चाहिए. Not only the information about the company, about the industry, about the economy, but also about how the share prices are moving or behaving in the stock market. So we have discussed about the CAPM. Now uses and limitations of CAPM. Next topic we are discussing about uses and limitations of CAPM. In real world, investors get higher return for higher risk and they are more concerned with company related risk rather than market related risk, except in case of trained investment analysis. So normally अगर trained investment analyst है तो he will give more concentration, more focus on market risk, whereas an individual normal investor, so he will give more concentration on the unsystematic risk, company related risk. Companies are found to use CAPM to determine the cost of equity of the firm. ये cost of equity of this कंपनीज जो है CAPM को यूज करते, क्यों यूज करते? टू फाइंड आउट द रिक्वायर्ड रेट ऑफ रिटर्न, द रिक्वायर्ड रेट ऑफ रिटर्न और हर्डल रेट. For hurdle rate or required rate of return, they calculate CAPM to estimate the required rate of return for divisions of line of business. अगर एक कंपनी है कई लाइन्स ऑफ बिजनेस है तो कितना रिक्वायर्ड रेट ऑफ रिटर्न एक एक लाइन ऑफ बिजनेस से मालूम होगा. टू डिटरमाइन द हर्डल रेट. कॉर्पोरेट इन्वेस्टमेंट, अगर कैपिटल बजटिंग डिसीजन ले रहे हैं, हाउ मच इन्वेस्टमेंट वी हैव टू मेक इन capital projects, again required rate of return is required, so CAPM can give the required rate of return. So in case of public utilities, the CAPM can be used to estimate the cost and rates to be charged to cover the cost. अगर public utility concern है तो they are not concerned about profit, they are concerned only about recovering the cost. So again the public utilities will make use this CAPM return to calculate at what how to recover the cost. Now historical return and betas are used to select the proper risk in investment. This is all about uses and limitations of CAPM. The last topic we'll discuss about arbitrage pricing theory. In simply it is called APT, arbitrage pricing theory. So the foundation for APT is law of one price. ये APT जो बेस कर रहा है ये लॉजिक के ऊपर बेस कर रहा लॉ ऑफ वन प्राइस. इसका मतलब लॉ ऑफ वन प्राइस, द लॉ ऑफ वन प्राइस स्टेट्स दैट टू आइडेंटिकल गुड्स शुड सेल एट द सेम प्राइस. दो सेम गुड्स अगर है तो एक ही प्राइस रहना दोनों मार्केट में. टू मार्केट्स आर देयर, ए मार्केट बी मार्केट. इफ पर्टिकुलर प्रोडक्ट इज देयर, the same product will be sold at the same price in both the markets. This is called law of one price. If they are sold at different prices, anyone could engage in arbitrage. अगर दो मार्केट्स में अलग अलग प्राइस चल रहा, सेम गुड्स का, सेम कमोडिटी का प्राइस अलग अलग अगर दो मार्केट में है तो देयर अराइजेस द अपॉर्चुनिटी ऑफ आर्बिट्रेज. आर्बिट्रेज का मतलब बाइंग इन वन मार्केट एंड सेलिंग इन अनदर मार्केट. अगर ए मार्केट में प्राइस ज्यादा है और बी मार्केट में कम है तो आर्बिट्रेजर विल एंटर इनटू द मार्केट. आर्बिट्रेजर आएगा, बी मार्केट से खरीदेगा जहां पर प्राइस कम है और फिर लाकर ए मार्केट में बेच देगा जहां पर प्राइस ज्यादा है. सो आर्बिट्रेज ऑल्सो अप्लाइज टू फाइनेंशियल एसेट्स. ये आर्बिट्रेज जो नॉर्मली अदर गुड्स के लिए अप्लाई होता है, फाइनेंशियल एसेट्स में भी अप्लाई होगा. इफ टू फाइनेंशियल एसेट्स, अगर दो फाइनेंशियल सिक्योरिटीज है और दोनों का एक्सपेक्टेड रिटर्न अगर सेम है, if they do not have the same expected return, a riskless profit will be earned by simultaneously selling at low return and buying at high return. Arbitrage causes prices to be revised as suggested by the law of one price. Arbitrage से क्या होगा? It will affect the prices. जैसा जैसा आदमी B मार्केट से खरीदेंगे और A मार्केट में बेचते जाएंगे तो डिमांड ऑफ द गुड्स इन B मार्केट विल इंक्रीज. जब डिमांड बढ़ेगा तो प्राइस भी बढ़ जाएगा और यहां पर सप्लाई कम हो रहा तो प्राइस भी गिर जाएगा, तो ऑटोमेटिकली इक्विलिब्रियम प्राइस विल बी अटेन्ड. तो assumptions of APT है कि इन्वेस्टर्स सीक रिटर्न टेम्पर्ड बाय रिस्क. दे आर रिस्क एवर्स एंड सीक टू मैक्सिमाइज द टर्मिनल वेल्थ. देन इन्वेस्टर्स कैन बोरो एंड लेंड एट रिस्क फ्री रेट. देयर इज नो मार्केट फ्रिक्शन सच एज ट्रांजैक्शन कॉस्ट, टैक्सेस एटसेट्रा. सो दिस इज अबाउट APT, arbitrage pricing theory. So we have covered the theoretical part of this portfolio theory, unit number 4. Now in the next session we'll start the problems on portfolio return, portfolio risk, and how to calculate the beta, and how to identify whether the security is overpriced or underpriced in the market. So these are the different types of problems we will solve in the next session on problems on